Good morning, traders. Chris Buss here with Traders Profit Compass with another edition of Before the Bell for Wednesday, October 19th, 6:56 a.m. as I'm starting the video. And as always, please run your player at 1.5x. Quick look at futures. We had a nice little rally going a couple hours ago, but that's since been faded. I see flat across the board. On the macro front today, we've got housing starts. We've got oil inventories at 10:30. Neil Kashkari of the Fed speaks at 1 o'clock. And we also have a 20-year bond auction at 1 o'clock as well. And then we've got the beige book at 2 o'clock. Over on the earnings front, ASML, before the bell, semiconductor equipment manufacturer. Procter & Gamble, Ally Financial. Ally does a lot with car loans. They may have a lot to say about delinquency rate, stuff like that for the consumer that might be informative. Abbott Labs, and then Travelers Insurance. In that insurance group that we've been talking about should be a beneficiary of rising rates. And while we're on the topic, I think overall right now the market is really wrestling with bad sentiment, bad positioning versus rising rates. I think this morning we topped, if I heard the TV right, 4.08% on the 10-year, which would put it at a high for the cycle. So, I mean, we've talked about the dollar here, dollar rising as a headwind for global liquidity. We have been talking about falling TLT being a headwind for equities, and we can see we had a marginally green day yesterday, nothing really to speak of, and I was looking on TLT here this morning in the pre-market, and starting off on a red day, and we've already talked about this weekly chart right here on the raggedy edge of this support here at 98. If bond yield goes on a tear, then we've talked about this void, and that can only be a headwind for stocks. So I was hopeful for a bounce just on positioning, a tactical rally. But you could see yesterday, we made that initial push, and then it fell back, which could be just, the symptom of the volatility that we've been talking about, still over 30, but lower. If we could break 30.29, then that would bode really well for a continued rally. So, keep the dollar in focus, keep TLT in focus, and of course keep the VIX in focus during your trading day. Bitcoin has gone absolutely flat, not doing anything, but just remember, volatility compression leads to volatility expansion. So this is, while it doesn't look like it's doing anything, it's building energy, right? This was an example back here in this flag, where there was a big volatility expansion, then a contraction, and then another expansion. So whenever you got these narrow ranges that develop, just keep in mind that whenever it breaks out, it has a tendency to have a more explosive move because of the the energy that's been building in the price action. So if you're interested in trading that, set your levels, have your proxies in place, whether that's going to be a long ETF or a short ETF, whether you're going to go to the futures market, however you're going to do it. Or, if you got enough money, just buy coins. But most people I know don't have, that kind of liquidity just hanging around. So probably an ETF or futures is what I'd say. Biden administration out, pedal to the metal on SPR releases. I can only assume that's part of this move. What I'm going to do today is after we go through our regular deck of charts, I'm going to hit the refiner charts. Just as an FYI, here in Ocala, Florida, regular unleaded gas is running about 330 to 335, and that's probably up a nickel in the last week or 10 days. But when you go to diesel, it's 530, 540. So really $2 higher than regular gas, and that is quite a spread. And remember, refiners make the money on the spread of that 3-2-1 crack spread. 3 barrels of oil refines into 2 barrels of diesel and 1 barrel of gasoline, more or less. So that crack spread has remained quite robust. And the interesting thing is on the diesel is inventories are at the lows. So there's not a lot of cushion in the system for diesel prices. And diesel's a code word for home heating oil. All the trucking obviously is affected by diesel. A lot of industrial applications are linked to diesel a lot more than they are gasoline. So, and that is really the primary reason why the refiners have held up so well. So, a quick look at our oscillators. They're making their way towards the top of the range. Same thing here on the NASDAQ oscillator, making its way towards the top of the range. Yesterday we had, basically a volatility day. We opened on the highs and more or less closed near the lows. We went down and filled the opening gap and then came up. I think the good news in the price action is we talked about yesterday on SPY is that our primary pivot is here at 370, and we managed to hold on to that. So we're above the 8-day, above the downtrend line, and above that central pivot of 370. And that, not to get oversimplistic, but I think it is that simple that if you're above 370, you want to be long, and if we can't hold it, then chances are it's going to roll down. Here you can see, and this is where how nimble are you, how reactive are you, how much do you want to trade, etc. So here was the opening bar, this black one, right? Came right up to 376. What was the high? 375.50. And what we always say to do on any kind of a gap situation, the very first thing you do is you mark the gap on your chart, whatever, whether it's a 10-minute chart, a 5-minute chart, a 30-minute chart, whatever you're doing, you mark your gap and you can stay long as the top of the gap holds. But if the top of the gap breaks, then you've got a short entry, and you can see here, as soon as that broke, then you came all the way down to 367.50 and filled that opening gap. So then that's your dynamic short-term trade. And like you see on the chart, it only took a couple of hours to make that $5 move. So that was a great trade. And then it popped back above 370. And although there were some wide-ranging bars, at the end of the day, 370 held. So from that standpoint, the central pivot held. And now I think we just recycle our thoughts from yesterday. Stay long above 370, and here you can look for 377.50 at these prior highs. Now, of course, you'll have a high here at 375, but not nearly as important as the one at 377.50, where you see the large volume over price bar and these rejections across the top. Same thinking with QQQ. We broke high, finished low, but held 270. We made a little inroad into this gap. We're not able to fill it. Moving on to the 60-minute chart, you can see we made this incursion here into this gap, but didn't really even get close. The high was 277, and the top of the gap is more or less closing in right near 280. But again, here, mark the top of the opening gap, and then once that broke, you got a swift move down, and then, as we've already discussed, held that 270. So again, I think 270 is your central pivot for today. One thing I did here, same idea, went up to resistance, came back, pretty much filled the opening gap. But what I wanted to show you is we've got that classic double bottom in place that we try to point out when we see it. Here's the left side of the W making a low, middle part of the W, right side, and then starting to build out the right side of the W. And remember, on a measured move basis, how you figure out where this might go or what your measured move target would be, it's going to be the height of the middle part of the W, 8.4%. And so I transpose that 8.4% over here to where the breakout would be, and that would send you up to 192. That's not a promise, that's just a projection. First things first, it's got to break this line of resistance at about 177.50. So, and you can notice here that the 50 EMA served as resistance as well. But from a technical standpoint, better shape than the other two. We're well off the June and prior lows. We're above the 8 and the 20. Now we're between the 20 and the 50, with overhead resistance being right there. So I would have 177 marked. Actually, you can put that alarm at 176.12 at the 50, just as a heads up. But I would be watching this line here, see the rejections, support, rejection. I would put it, right in here at a little higher, like 177.50 for an alarm to get long. But, pretty constructive bottoming pattern on that double bottom. And notice the bonus is the positive divergence, right? On RSI and PPO. Here we had a low with a low in PPO and a low in RSI. We came back to the same point in price, but yet at higher momentum and higher RSI. That's your buying power under the surface, at the prior low, where normally you would expect momentum to be low. So that is a kind of a confirming sign on a double bottom, and something that you'd like to see at that point. Here it is on the 60-minute chart. You can see it ran into trouble right here at 175.50. Support. Resistance. Now, one of the things that I was just playing around with, but I didn't draw in, I think we talked about it yesterday, is imagine drawing this whole range in as a trading range, and you can see, $6 wide here. What's your measured move on a breakout? Add $6 to it. So $6 to 170 is 176. We hit that yesterday. Funny how that works, right, to resistance. So now if we take the whole thing, we've got a $12 trading range. And if we were to break out above, let's just round it off to 176, if we add $12 to it, we come up with 12 onto 176 is 188, which would put us into this gap. And then once you're in the gap, you'd expect a gap fill. So just, again and again, using these TA tenets principles to kind of line up what you're shooting for, and then layered into that is if you get a breakout here, where's your target? And if you've got a $12 target, that can lay into your how much risk do you want to take on the position, and where do you want to put your stop? For example, if you're shooting for the home run, and that's $12, you got to have, or it's a good policy to have at least a 3-to-1 risk-reward ratio. So if you are going for $12, you can afford to put a stop $4 below, right? So there's your 1, and 12 is your 3, so that's 3-to-1. If you want to tighten that up, you can go 4-to-1 and set your stop $3 below. And see, that would make technical sense here. Say at 176, if you set a $3 stop, you're down at a technical support level, which would make sense, from a technical standpoint. Where would you expect support to kick in? And it's right here at 173 where you saw it. So just some ideas on risk reward and layering in a measured move target into your strategy for where you want to shoot for, and then how much risk do you want to allow for. Meta, pop and drop, nothing's changed. 134 is your pivot, hoping to break into an $8 range where you can target 142. Apple came right up to this top of the channel for a touch. You see that bar, and then spent the rest of the day, trying to get through 145.50, but not being able to do it, and then finally giving up the ghost, coming down here, filling the opening gap, actually reaching all the way down to the midpoint of the channel. And if you're Johnny on the spot and you're generally bullish, you had a nice chance there to buy, because you had two lines in the sand going in your favor. One, a reach back to the midpoint, and also a reach back to the top of the gap that held. So I didn't do that, but that certainly would have been a great trade, because then you got the bounce after that, technical touch down there on the bottom. So now, as long as I think the central pivot remains 142.50, and got to get the breakout. Got to get the breakout above the downtrend channel, and that would open the door to filling these gaps above. Tesla oscillating ahead of earnings. I don't know if I went through the afternoon list. Tesla up this afternoon. IBM, Lam Research, Alcoa, and Kinder Morgan are after the bell. So this is probably all just, hesitating, waiting for the numbers. We'll see what happens. Netflix certainly had a well-received result. Maybe Tesla will too. Microsoft, excursion into the gap, came back to fill the opening gap, came back down to touch this 235, which is really our central pivot on this chart. And if you bought 230, people that have been buying 235 are still in good shape, whether it was the day before yesterday and here, or on this back touch. All those back touches have held so far. Just got to hold 235 to keep the door open for a move back up to 242 and to fill that gap. Same kind of chart pattern for Amazon here. Excursion into this gap, but did not fill, then came back and then held the central pivot at 115. I think you can be long above 115. Below 115, I would be careful. That would open the door down to 112. Google, no coincidences, right? Rejection, 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 rejection. We talked about 103 yesterday, actually even before then a couple times. Came right up to 103. Price knew exactly where it was, reversed on a dime, and went back to the central pivot here at 100. So really the only thing left to say is, it either holds here at 100 or it doesn't. If it doesn't, chances are it comes down here to 99 and potentially fills this gap back down to 97, bottom of the box, or it breaks out 103 and we have a rally up towards 109. Remember, we've got $6 wide if we go from 103 to 97, and if we break out of 103, that projects to 109 up here at the gap. Netflix obviously is going to be off the chart here this morning. I think I looked, we were trading 275 in that range. So in your charting, remember we've got a $100 gap that goes from 248 to 348, more or less, and then we've got price in the pre-market trading 275. So we've got airspace on either side, right? We've got the $75 that's left to fill on the upside, and then we've got the $25 on the downside once the open happens. There'll be $25. Well, actually, take that back. We were down here at 240, so if we're trading 275, we'll have $35, right, of gap airspace between last night's close and the open this morning. So if you get that may be one really to watch, because if we get a runner either higher or lower, you're basically running in air, right? There's no technical resistance because of the gap. So you could get something that moves really, really fast today, depending on, what price does, whether it breaks higher or lower out of the gate. SMH was a nothing burger, absolutely flat, nothing going on there. Running through ARC, started out good, but fell back. You see ARC F right at the downtrend line, but coming off of support at 15. My upside target would be 17, so we're right in the middle of that little trading range. Same kind of price action here. I think your pivot remains 31.50, and as long as you're above that, I think you got a good chance of coming to at least back touch the bottom of the trading range at 34. Flagship fund up 1.6, really coming in to try to back touch this 40-41 area at the bottom of the prior trading range. I would be, if you got long, I think you can stay long above 36, as we've discussed on quite a few days recently. ARCW, trying to make inroads into this trading range, really couldn't quite do it. Fell a little bit short. I've got the range starting at 46, closed at 45.50. Be sensitive to the fact that just from a technical perspective, big trading range, breakdown, back test that got rejected, right? We went into the old range, but then closed below. What we've got here is technically speaking, is a breakdown and a back test. So if you get the sense that either ARC or the market in general is rolling over, you got a really objective short here, because you've got really three elements of the setup. The breakdown being the first element, the back touch being the second element, and then the rejection being the third element. And then you can set your stop. You got a really nice setup to set your stop just above, and then you're looking for the big move down after the back test, one that you could stay in for, potentially weeks if the whole thing falls apart. So I think that's a real objective setup. Moving on to the refiners, we talked about that crack spread being really wide, and I showed you the oil chart where oil's been falling apart. The Biden administration just talked about, we're going to, they went from winding down the SPR releases to cranking them back up. I think there's going to be an announcement today, which is already pre-publicized, so I'm not sure it's going to have a big reaction on the charts, on the oil charts, but that they're going to release another 15 million barrels probably between now and the election. So that's been bringing oil prices down. But if you think about it, if diesel prices remain high and oil prices are dropping, that means the crack spread, the difference between what a refiner makes between his input cost and his selling prices, is going up, right? Raw material cost is coming down, and the value of his products are going the other way. Diesel's going up, it's not going down. So the crack spread is actually increasing as price goes down. And you can see that these refiner charts don't look anything like the rest of the market. These are at 52-week highs trying to break out. So here's Dino right here. That was up 3% yesterday. That little sell-off thing didn't even phase it at all. You can see that we made a run at this high. We pulled back to the 20, and now we're back above the 8, pressing against 52-week high resistance. Here's PBF breaking. I haven't got the line in here, but I can see here it's at 44. Breaking out. Good day yesterday, almost 3%. Riding the 8-day up. I like that chart. Nothing not to like, let's put it that way. Phillips 66 lagging to a certain extent. Not near up to highs, but certainly breaking out of this high volume over price bar here at 94. If you wanted to, if you got to pull back to the 8-day at 94, I think that would be a good buy. Might not get that chance if you wanted to, just take it now, or if you don't like this one, whatever. I still think this is in a good technical posture. And while I got this here, I just want to show you, see the W forming? Left side, middle, right side, building the right leg here. And notice here, it's a divergent low. Whereas, remember on IWM, we had equal lows to form a double bottom. Here we've got a divergent low, which can be even more and more powerful. We had a low here. We made a lower low, but in momentum, we made a higher low. So there's your divergent low with positive divergence on the on momentum. Really not much here on RSI. You can see at this low, we were at a low, and then we came down and equaled that low. But 1 out of 2 ain't bad. Having positive divergence on momentum is a good thing. You see it here also on Valero, although I've got the actual low here obscured by the label. You've got lows here in price. You come in for another tag of those lows, and you've got divergence on positive divergence on momentum. Just like PSX, a little not as robust as some of those other refiners we looked at, Dino and PBF, but a break above this value area should open the door to these 142s and prior highs. I've been wrestling with this XOM, ExxonMobil, running out of time. I'm in 100 calls for Friday. I mean, it's just got to pop today. A lot of the premium must come out. And what's been frustrating about this is, it's just toggling between, it's building a flag is what it's doing. Here's the impulsive leg higher. Here's the flag. Just haven't got the explosive breakout yet. And if you've been sitting on the sidelines on ExxonMobil, you can set an alarm here at 102, 103, wherever you want to take it. If you get that breakout there, I think it's going to be gone. Just from the technical formation, the strength of the energy names in general, and taking out this prior high here at 103. I mean, those are all touchstones on the way to making higher highs. And one thing that's helping, remember, they call them integrateds for a reason. When you look at ExxonMobil and Chevron and some of the integrated names, they've all got refining capacity. So unlike an E&P name, like Fang or Pioneer or one of those other names that are just drillers, when you get into these integrated names, they've got that highly profitable refining component within their business units, and I think that's been helping the integrated names that we talked about. Hess, ExxonMobil, Chevron, ConocoPhillips, COP is another name you can look at. I think the refining component of these integrateds is helping them along. And then I want to wrap up with Allstate. We talked about this being an industry, there aren't many of them that really benefit from higher interest rates, but what the higher rates allow these guys to do is, of course, lock in higher rates for the massive liquidity pool that these insurance companies need to hold for potential claims. So whereas, let's say a year ago, they were getting, almost nothing on 2-year paper or 6-month paper, whatever they get, whatever their matrix is of liquid instruments that they hold. Well, now they're getting 4%. So, and that's just pure profit because none of their expenses change or anything like that. They're just getting a much higher return on their asset base than they would with low rates. So what you're seeing here is benefiting from that rising rate environment. So let's wrap it up there. Stay on top of your toes. Keep the dollar, keep the VIX, keep TLT in your matrix. I still think people are offsides to a certain degree, loaded to the gills with puts. We've got OPEX on Friday. I don't think they're going to let all those put buyers win. I think it's a recipe for either treading water or going higher as people probably bail out of those puts, seeing that it doesn't look like they're going to work. And maybe that will fuel a bit of a short squeeze here. But then the headwinds to that are, of course, the rising rates and the rising dollar. So you've got very short-term dynamics there with a potential short squeeze, and the long-term dynamics are still really not favorable. Don't forget, the Fed is going to be raising rates the first week in November, and that's right around the corner. Probably already priced in, but you never know how the market's going to react to that. So the liquidity from the overall system continues to drain away. So let's wrap it up there. Hope you got something good out of the video. Of course, if you're new, subscribe, hit the alarm bell, jump over in the show notes, find the link to add your email to our list, join the club. You'll get all my content right to your email box. You won't have to hunt for it. And then if you want to join our trading room, we'd be glad to have you. You'll get an invite to that as well. So hope you guys have an inspired day of trading. Remember, objective trades honor your shorts or honor your stops at all times. Volatile environment out there. You can make a lot very quickly, or you can lose a lot very quickly if you find yourself on the wrong side of a trade, wishing and hoping. It can evaporate real fast. So if you get stopped out, might be frustrating. Just reload, find your pivot, and then re-enter the trade if it reverses and heads back to the direction that you thought it was going to go in the first place. And if the volatility is just too high for you, no shame or harm in stepping aside. You'll save yourself a lot of money. So let's leave it at that. It's been Chris Buss with Traders Profit Compass. Have a good day. Talk to you next time.